Hello and welcome back. Markets are back up after a pretty disappointing start to the week, but I can see the elements of a trap forming, and I want to break that down for you so that you can avoid it, so that you can avoid getting caught out and stay in the green. Let's jump into it right now. So take a look at this. Bitcoin currently at a price of near enough $96,000. We are up at the time of recording 5.82% from the lows put in earlier today. And the high today, 97,451, was in fact 7.38% up from the lows put in down at $90,757. Now yesterday we were looking at potential scenarios for this move. We were trying to predict a good place for the market to bounce, and we got pretty close to the 90k level that we were looking at. Now the first bounce that came in around about 1 p.m. was from the point of control of the volume profile that we drew from the beginning of the Trump rally all the way to where we were looking at the market yesterday. Point of control is the area where the most volume has been transacted over whatever time period the volume profile is drawn. And these are generally areas of higher liquidity that tend to act like a magnet for price, but they can also be a good place for the price to bounce from. So after that initial move up yesterday, topped out around about $95,000. That was the former all-time high. And we kind of flipped that from resistance into support somewhat. As you can see, we broke it back on the 21st, bounced off it to the upside initially on this down move that started towards the beginning of the week. Then we broke back down again through that, and that became resistance from the first bounce back up again from that $91,500 level. Where we eventually bottomed out was close to that $90,000 level that we mentioned yesterday. Now we knew that $90,000 was also, perhaps more significantly so, former resistance flipped into support, and it was also within that volume profile, within that high volume node of the volume profile. And looking at the order book aggregators, we could see that there was a spike of buy side liquidity waiting down at $90,000. And where we did indeed end up bouncing from was just a little bit higher at 90,757. So Bitcoin up just over 6%. Same story for the whole market pretty much. If we take a look at bubbles, you can see basically everything is up today. But I think this might be a little bit too much too soon. I think a lot of people today have seen the green candles and they've got potentially too excited and gone too big too soon. And the reason I think that is because of market sentiment and because of leverage. If we take a look at the fear and greed index today, you can see we are down somewhat from the scores we saw towards the start of the week, actually now sitting at about 75. So we're just greedy. We're not extremely greedy. But crucially, if you take a look at the Bitcoin exchange liquidation map, you can see that there is now basically a mirror image of what we were looking at the start of the week. And that means that there is a massive disparity where we have much bigger long liquidation leverage in the market than we have cumulative short liquidation leverage risk in the market. And this tops out at some really key levels. First of those being the low from today, $90,757. That price represents around $3.88 billion of cumulative long liquidation leverage risk. That is to say, if we were to teleport down to those prices right now, if we were to crash suddenly to $90,793, the cumulative long liquidation leverage risk would be such that $3.88 billion worth of liquidations would be caused. Now, obviously, that is hypothetical. It's very unlikely we would move that quickly down that far. But this still speaks to a huge amount of long leverage in the market. It speaks to a huge amount of long leverage in the market that has jumped in on sight of those green candles. And that is the makings of a classic bull trap. I'm going to play a clip now from yesterday's video where we basically spoke about how this potential situation could have formed. And it's interesting to watch this back now because the scenario is shaping up in a pretty similar fashion to the one that we hypothesized here. Prices continue to drop. Maybe we see a little relief bounce. Everyone sees the bounce up, starts to get excited again, starts jumping on leverage. We could see a return of this danger liquidation level towards the bottom of this range. That is pretty much what it seems like happened today. A lot of people saw those green candles, a lot of people jumped in on leverage, and now those liquidation risk levels are reappearing. And the second level that I mentioned in that video is the bottom of this range, and that would be about $85,000. And so if we take a look at what that looks like in terms of long liquidation risk, that puts us at least $4.28 billion worth of long liquidation risk. These prices are quite far away to the downside, but we are coming into resistance. This bounce is slowing down, and this was a pretty fast move. So it is absolutely not beyond the realms of possibility that if we see a slowdown of this bounce, if we start selling off, we could see this magnified to the downside. And this might be a red herring of a bounce. We might indeed see a pullback much deeper into the book before an eventual move upwards from there. And remember, these positions don't actually have to become literally liquidated. They can unwind, they can get out of those leverage positions. That will still involve selling to the market. It's just the situation where they end up becoming actually liquidated. People start going off. That's when you can get that really dramatic cascading effect to the downside and a price dislocation because people are selling on surprise. They don't even know they're selling, right? In that scenario, they're actually selling involuntarily. But either way, it's still selling. It just depends whether the move down is going to be controlled and slow and gentle, or whether the move down is going to be dramatic and fast and result in a price dislocation. If it is indeed the second of those two scenarios, that presents a really good buying opportunity, not just for spot holdings, but also potentially for short-term trading. That being said, it doesn't have to happen. There's plenty of support down here. As we've certainly seen towards the end of last week, plenty of buying in the ETFs, plenty of buying from corporations. Although I will note that buying has slowed down over the last couple of days. You can see the 25th and the 26th were in fact small outflow days from the spot Bitcoin ETFs. So the message is basically remain cautious. Don't be the person that jumps in right at the top of the market on massive leverage in a position that you can't afford to lose, because that increases the chances that you won't have the backbone or you won't have the funds to hold that position open long enough to see profits. But in any case, that is not financial advice. That is just purely my opinion. Thank you so much for watching. I really appreciate it. There is plenty more to come. Catch you in the next one. Bye.